12. How to choose your investment. Before start investing any asset class, you should understand some of basic things like duration of investment, risks and benefits of particular asset, diversification of assets, benefits of diversification. All those are essentials to know. Here we learn some basics of how to choose your investment. 1. Know your timeline. You need to commit to a period of time during which you will leave those investments untouched. A reasonable rate of return can be expected only with a long-term horizon. When investments have a long time to appreciate, they're more likely to weather the inevitable ups and downs of the equities market. It may be possible to generate a return in the short term, but it's not probable. As legendary investor Warren Buffett says, "You can't produce a baby in 1 month by getting 9 women pregnant." 2. The magic of compounding. Another important reason to leave your investments untouched for several years is to take advantage of compounding. When people cite the snowball effect, they're talking about the power of compounding. When you start earning money on the money your investments have already earned, you're experiencing compound growth. This is why people who start the investing game earlier in life can vastly outperform late starters. They get the benefit of compounding growth over a longer period of time. 3. Choose the right asset classes. Asset allocation means dividing your investment into several types of investments, each representing a percentage of the whole. For example, you might put half your money in stocks and the other half in bonds. If you wanted a more diverse portfolio, you might expand beyond those two classes and include real estate investment trusts, REITs, commodities, or international stocks. To know the right allocation strategy for you, you need to understand your tolerance for risk. If temporary losses keep you awake at night, concentrate on lower risk options like bonds. If you can weather setbacks in the pursuit of aggressive long-term growth, go for stocks. Neither is an all-or-nothing decision. Even the most cautious investor should mix in a few blue-chip stocks or a stock index fund, knowing that those safe bonds will offset any losses. And even the most fearless investor should add some bonds to cushion a precipitous drop. 4. The rewards of diversification. Choosing among various asset classes doesn't just manage risk. Greater rewards come from diversification. Nobel Prize-winning economist Harry Markowitz referred to this reward as the only free lunch in finance. You will earn more if you diversify your portfolio. Here's an example of what Markowitz meant. An investment of $100 in the S&P 500 in 1970 would have grown to $7,771 by the close of 2013. Investing the same amount over the same period in commodities, such as the benchmark S&P GSCI index, would have made your money grow to $4,829. Now, imagine you adopt both strategies. If you had invested $50 in the S&P 500 and the other $50 in the S&P GSCI, your total investment would have grown to $9,457 over the same period. This means your return would have surpassed the S&P 500 only portfolio by 20% and be almost double that of the S&P GSCI performance. A blended approach works better. If you want to see full video, click here to watch. If you like this video, please share with your friends and family, subscribe for more videos like this. Thank you for watching.